And welcome to our Financial Well-Being, Managing Credit and Debt Wisely presentation today. My name is Victor Russell. I'm the Operations Manager with Apprisen. We are a nonprofit agency that we partner with Impact Solutions in their EAP program. And we help individuals with personal financial management issues. And today's discussion is really going to revolve around debt and how debt can become stressful, especially during these unprecedented times that we're in with the COVID-19 pandemic crisis. Certainly challenging times, but there are certain levels of stress that individuals feel when they have too much money going out, not enough money coming in. And so we're going to approach this financial well-being discussion in addressing debt issues and what an acceptable level of debt is. Some of you may say it's 0%, which is great, but you do have to obtain some type of debt in order to move forward in your life as well. So we are going to discuss that in detail. We're also going to discuss some trends as far as overall debt goes, and some things that really during these unprecedented times really apply to how we can manage our debt effectively now. So with that, before I get started, I wanted to talk about some of the issues from last week in your presentation. So what we have are some skills building from week number 2. And you can see that what we'd like you to do here is write down the answers to these questions and place them where you can see them on a daily basis from your presentation last week. Specifically, what major changes, professionally or personally, am I coping with right now? Identify at least 2 opportunities that could come from these changes. Name at least 1 short-term goal for this work week. And then plan and do at least 1 self-care activity for this week. And lastly, make a list of 5 things that are within your control or influence. And there's some hints there that are provided for you to help you with that list. And it's just a way for you to review what you learned last week or what you discovered last week during the presentation. To help you carry those thoughts over into this week and moving forward. This really helps you move forward with what the discussions that took place last week. And of course, for this presentation today, I've created a list of questions that you'll be receiving, next week's presentation. So make sure you have this information and you're ready to move forward with reviewing what was covered last week in your presentation. Okay, with that, I'd like to get started on the financial well-being presentation and just a few statistics that we talk about as far as debt goes. Right now, the debt levels in the United States of America are an all-time high with consumer debt right around the $14.1 trillion mark. Now, we've all heard about the level of student loan debt that's in this country. It's right around $1.5 trillion right now. But credit card debt and unsecured debt is fast approaching, or is right about the 1 trillion mark as well. And it really has increased in the past 6 months, a year and a half. Where it was actually reducing there for a period of time, but it has gone up. So when we talk about financial stress, and usually it's debt that causes that stress, or how am I going to move forward with my life in order to feel good about myself or feel good about the situation that I'm in. Creating some individuals unfortunately create debt to help themselves feel better. And it really becomes a self-fulfilling prophecy, whereas you're actually getting behind and not getting ahead. So a couple of the questions we're going to start off with today. Number one, pretty simple question. What is debt? Well, debt is when you borrow money and you agree to repay that, whatever you borrowed with interest. And the amount of interest you're going to pay, of course, is dependent on what type of loan offer you signed up for. But the thought-provoking question is, how do we get into debt? And some individuals when we talk with them or get their perspectives on debt, they assume it's just a part of life that you have to live through, and that you're always going to have debt. And that may be true if you don't have a financial goal in mind, to where there will be a day that you won't have much debt, if any. And so making those decisions as you move forward, and making the right decisions as far as debt goes, really boils down to a couple of issues. Where did you learn? What were your thoughts about money? Where did they come from? And how you're managing your credit, because credit management is extremely important when you talk about debt and how much you're going to pay for it. Because I think we all know, the better the credit score that you have, the less interest you'll pay on the amount of money that you borrow. Interest rates right now on mortgage loans, if you have a good credit score, for a 30-year mortgage right now are under 3%. Unprecedented levels of interest rates. The lowest they've been in 55 years. And for a 15-year mortgage, it's actually down around 2.3 to 2.4% for a 15-year mortgage. So as long as you have that good credit score, you won't pay as much for your money, and you'll be able to build assets. And that's why experts right now say it's a seller's market. There are a lot of people looking for homes. Believe it or not, during a pandemic crisis, a lot of individuals are looking for homes, and there aren't enough homes to sell. So just a couple things I want to take a look at here briefly, because a little short on time. But the one thing I want to concentrate on this screen here is that those last bullet points down there. We had the $8 billion of revolving debt, where it's showing up in the yesterday section. What we like to do is compare consumer trends, or how individuals borrow money now compared to back in the 60s, 70s. So back in the 70s, $8 billion of revolving debt. Anytime you see the word revolving, that is credit card debt. Look at today, and as I just mentioned, it's about $1 trillion now in revolving debt. And you can see the disparity there on how easy money is to get. The big issues that we see today with our agency are individuals signing up for these online loans, which are very expensive. They're very easy to get. And when we say instant credit is routine and we spend more than we earn, especially during these times, these online loans, we're seeing a real problem with these. The problem with them is they really don't have any credit checks, and they have very high interest and very high repayment schedules for those. So I would recommend not using those online loan products because they are very expensive. Another trend, just to take a real quick look at where credit card debt's been and where it goes. And I started in the lending industry in 1985, and as you can see from this curve, that's about the time credit card debt really started gaining popularity in the United States. I remember looking at credit reports, and I would see on a credit report individuals with maybe one or two credit cards at the most back in 1985. But as I became a supervisor in the early 90s and throughout into the 2000s, when I was in the lending industry, we started seeing individuals with 5, 6, 7, 8 credit cards on their credit reports, and you can see that's reflected in this curve to where you see credit card outstandings just escalated during the 90s and the early 2000s. And then when the Great Recession hit, as you can see there in 2008, credit card debt started reducing because financial institutions weren't putting as much money out there as far as credit card offers. And then, of course, you had the Credit Card Reform Act that took effect in 2010. At the same time, the savings rate in the United States, as credit card debt was going up, the savings rate started going down. Individuals started saving less money. So we were spending more via credit, but saving less, which made for the perfect storm when the Great Recession hit in 2008. And you can see that the savings rate during that period of time went down, but then started trickling up as we started to recover as a nation as far as the savings rate for individuals. So at the same time, credit card debt started going down, our savings, personal savings started going up. So few questions people you have to ask yourself when you're taking a look at debt. Is there good debt? And you may say, no, there's no such thing as good debt out there. And what is bad debt? So is there good debt? And the answer to that question is yes, there is good debt out there. It's debt that can build assets. And usually the ways we build assets as we move forward in life are to purchase a home, which is probably your single biggest asset you may have. And when, as you move forward in life, and especially now, I heard the average value of a home right now in the United States is about $305,000, and it's going up. And once again, it's because it's a seller's market out there. So the price of homes is going up. And it's a little amazing in the light of a pandemic crisis that the real estate market is kind of lifting up, what's going on as far as consumer loans. Of course, some individuals invest in other properties as rental properties, and then appreciating assets, which could be stocks, whatever the case may be. But debt can also lead to opportunities to better our lives. And we talked about the student loans. Which, by the way, student loan interest is being forgiven through the end of the year now due to the pandemic crisis. So if you have student loans, there's an opportunity. If there's an issue with income that you won't have to pay the student loan, and there won't be interest accruing on it as well. You need to contact your loan servicer to understand what the ins and outs of that are. Purchase an automobile, transportation, could be work truck, whatever the case may be. If you're self-employed, investing in your business. So we talked about the good debts, but now what are the bad debts that we consider? And the bad debts that we take a look at is debt that really doesn't help you build assets, has very high interest rates. And those would be, of course, your revolving debt, as we mentioned before, which would be credit cards or any type of signature loan that you would be taking out. We put a bullet point in there, debt used for disposable items like food. Now, if credit cards are used correctly and you're getting rewards, like I use mine, I use it, pay it off, and I get rewards. They actually pay me to use the card. That's a positive. Because you're actually receiving something in return for using a service. But if you're carrying a high balance and you pay just a minimum payment every month, that's not the correct way to manage your credit card debt, because it can cost a lot of money making just a minimum payment every month. And the credit card statements right now, they show you a box on the side of their statements that tell you how long it's going to take to repay that debt if you just make the minimum payment every month. And it can be eye-popping numbers if when you take a real close look at it. So really, bad debts are those that linger, that have high interest rates, and that cost us a lot of money in the long run. That can obviously be an obstacle to building wealth. Whenever you're taking out a loan, you make sure that you're taking a look at what we call truth in lending disclosures. It's required by federal law. You have to have the annual percentage rate listed, and they're usually listed in big, bold, black print, especially on credit card offers. Any fees that will be charged, the grace period that you will have, and any interest computation, how interest is charged. Different types of credit that we're looking at. Installment loans, this is where you would take out an automobile loan for a fixed period of time. In other words, as long as you pay the $250 a month for 48 months, the loan will be paid off. You can see that it happens with car, boat, RV loans. We'll give you an example down there. The car loans can be financed from 36 to 72 months. A couple interesting statistics that I got from the Federal Reserve Bank. The average length of an automobile loan right now, new automobile loan, is 78 months. So individuals are paying on automobile loans for 6.5 years on average. We have seen automobile loans, individuals that come in and talk to us about their finances as long as 10 years. Your car may not even last 10 years. And over a 10-year period, look at the interest that you're paying over that amount of time. And the average price of a brand new car right now, the average monthly payment that an individual will make during those 78 months is $550 a month. Pretty high numbers to purchase a new automobile these days. And really, you should not be spending any more than 12% of your net income on an automobile loan payment. So keep that in mind. And that's why leases really came back in vogue, about 5 years ago, 4 or 5 years ago. It's because the price of a new car on a lease, obviously, you never own it, but it stays lower than if you were to buy the car outright. Other types of credit, of course, mortgage loans. We talked about this. The only thing I'll say about mortgage loans is you always want to get that fixed rate. The adjustable rates, unfortunately, can go up and down. If the Federal Reserve Bank ever decides to take us from 0%, where it's at right now, and start boosting the interest rate up a little bit, then your interest rate on that mortgage loan is going to go up, which will affect the amount of interest you're going to pay, and also the length of the loan as well. And believe it or not, individuals back before the recession would take out what were called interest-only loans, which were they would just pay the interest on the payment to keep the payment low, and the balance on the mortgage loan would never go down. Usually investors did this when they bought homes and they knew they were going to appreciate in 2 to 3 years, and then they would just sell the home for a profit by paying only the interest. Don't see many of those anymore out there due to some of the reforms that were done by the Consumer Financial Protection Bureau. So credit cards, once again, revolving debt, department store cards, home equity lines of credit. These are big credit card accounts, basically using your home as security. So when you hear something called a HELOC or home equity lines of credit, you have to consider the cost of those, which we have listed there. The interest rate that they're going to have, how the interest is charged, is an adjustable rate or fixed rate, and how long do you have to borrow on that home equity line of credit. Most important is after the draw period is done on that HELOC loan, what could my payment be if I max out that credit line? Some people are really shocked by how high that payment could be when they take out a home equity line of credit and they borrow all the money against it, and then when it readjusts, when you have to pay it back, the payment can be really high. So this is an important part that I want to cover right now. Some challenging questions, and these are some key numbers that I want you to keep in mind that will help you live stress-free as far as debt goes. So, number one, how do we manage debt wisely, and what is an acceptable amount of debt? And once again, I'm sure a lot of you are saying 0% or zero, no debt is good debt. But in order for us to proceed in life, and if we want those items now, instead of waiting to save up $305,000 to purchase a home, we will finance a home through a financial institution, make monthly payments at very low interest rates so we can enjoy that style of living now. So I want you to keep this in mind. This is extremely important when you're taking a look at your overall financial management and your debt levels. So how much is too much? Well, the general rule of thumb when you're taking a look at your debt levels, your debt payments, and this doesn't include keeping a roof over your head. This doesn't include your mortgage. It doesn't include your living expenses. These are just debt payments. Your total debt should never be over 15% of your income, your take-home income. And you can see examples of the debts that we talked about here: car loans, personal loans, student loans, minimum payments on credit cards, and home equity loans. Once you start getting to that 20% of your net income, your take-home income, you've got too much money servicing debt, and you don't have enough money for the other things it takes to live. Because let's face it, once you put your mortgage costs in there or your rent cost in there, which should be no more than 30% of your income, you need the rest of your money to live. Utilities, food, entertainment, all those other items that you need to have in order to live. you need to make sure that you have enough money for that. So how you figure that out, simple calculation, your debt ratio, or the debt to income ratio. This is just debts now, as we talked about. This is how you would figure it up. So we gave you an example here of a family bringing home $2,200 a month and having debt payments of $400. So you simply take the $400 worth of debt payments. That would be car payment, student loan payment, credit card payments, anything that's a debt, medical bills, $400, and divide that by the net income that you're bringing home each month. And in this case, that family has 18% of their income servicing debt. Now, that's right in that range of 15 to 20, but at the same time, they are fast approaching that 20% factor that we don't want to hit. You don't want to get close to that. So they probably should come up with a strategy in order to reduce their debt so they can save more money and build more assets that way. So just some information on credit cards are usually 3 to 4% of your balance. And then there's some strategies here. I know this is being recorded, so you'll have this, to how you can repay debt by paying more than the minimum payment. I just want to put this in perspective here. As you're taking a look at that bottom line on a furniture payment at 18%, look how long it takes you at 18% to pay back $2,500 that you borrowed. 12 years to pay back $2,500. Now, if you make more than the minimum payment, you can obviously cut that time in half. I know everybody's heard that if you pay an extra mortgage payment on a 30-year mortgage every year, you will have that 30-year mortgage paid off in 24 to 23 years. So if you just make one more mortgage payment every year on a 30-year mortgage, you will cut 6 years off of your mortgage term, which is you have to ask the financial institution to take that extra payment and put it towards your principal, but it can be done. You can reduce that debt in a shorter period of time. So as we wrap up, a couple more challenging questions. Where can we find the extra money in order to get this debt reduced? Well, you really have to create a spending plan to prioritize spending. So you make sure that debt, lowering debt becomes your main priority. Frees you up to save more money, build for retirement. There's other ways to increase income. You may be able to, add income, work a side job, or whatever the case may be, what they call gig jobs in a gig economy, in order to make more income to pay down the debt a little bit more. But making that spending plan, and let's face it, when you're in control, how do you feel? You feel very confident, less anxiety. When it's out of control, that's where the anxiety comes in. That's where the stress comes in. And we all know that stress can really wear on our physical health. Some other examples of creating a power payment plan with your debts, as you take a look at each one individually. I would approach it by paying off a higher interest debt as soon as possible, because that's costing you more money. But some folks like to take a look at the lower balances, pay those off first to feel some sense of accomplishment. I'm going to skip to the 8 rules of smart credit management since we're just about out of time already. But if you follow these steps, simple steps, I can't guarantee that you'll be successful with your personal financial management, but you'll be pretty darn close. So number one, you got to know what you owe. Remember, 15 to 20%, you want to fall in that range, but you want to be closer to that 15% figure as far as your debt levels of your net income. Obviously, live within your means, because that means you're not borrowing a lot of money and you're saving more. Spend less than you earn, so you save money. Borrow only what you can afford, and I provided the percentage that you should use as a guide. Recognize the warning signs of financial difficulty. Obviously, if you're using credit and not paying off the credit cards every month and paying interest and using them for things like grocery shopping and you're eating out too much or whatever the case may be, those may be warning signs of financial difficulty. More importantly, maintaining a good credit rating, managing your credit correctly. Make sure you check your credit report annually. And right now, on the annualcreditreport.com site, you can actually check your credit because of the pandemic crisis every week, all 3 credit reports for free on the annualcreditreport.com site. And that helps you guard against identity theft as well. So I got some additional sites there, including the annualcreditreport.com site, to make sure you're keeping a close look on what your credit looks like. If your debt levels are low and you're making your payments right on time to your creditors, chances are your score is going to be high. And with that, I just want to say thank you. And here's some information about the Ohio State Employee Assistance Program. Information about your EAP program is listed there. And of course, valuable services, especially during these very challenging and uncertain times. Please take advantage of those. So with that, I'll turn it over and see if we have any questions that we have from the audience.
Thanks, Victor. We do. We have a number of questions today, and I'm just going to apologize in advance, everyone. We're likely not going to be able to get through them all, but we do appreciate people using the thumbs up. It looks like we've got a lot of questions that have been voted up. So I'll kick it off. For the past several months, many of us have become more aware of past and present discrimination against BIOPC or people of color and the mechanisms we use to accumulate wealth. Are there ways people who have been discriminated against can find out about how to compare what they are being offered, for example, credit card interest rates with standard rates?
I can only answer that question by saying, from a lender standpoint, that, we used the same scoring models in determining interest rates for our loans across the board. I mean, that really was not an issue where I used to work. I've now been with this nonprofit agency, Apprisen, for 19 years. So I believe that the mechanisms that financial institutions use, and I mentioned before, keep that credit score as high as possible. As long as you're maintaining positive credit management and your credit score is as good as it can be. And when I say a good credit score, I'm talking like a 730 FICO score. Then I think you'll receive the lower interest rates.
Okay. Another one. If you are saving money for a house, would it be better to put money towards your credit card debt or keep saving for the house?
It's a very good question. I get this question often. And it usually comes in the form of savings. Now, I would say if you've got credit card debt, there's one thing you may not know is that if you're over 1/3, your balance is 1/3 of what your credit limit is, and it's going over that figure, your credit score is going to start dropping. So if you've got a high level of credit card debt and it's real close to the credit limits, you've got to get that credit card balance down as soon as possible, because that's going to affect your credit score negatively. And no matter how much money you save up for your home, you got to have that good credit score in order to get the best terms. I mentioned the interest rates and how low they are. So I would say you have to manage that process. If you need additional assistance with that, we're available by chat, through the EAP site. Take a look at Apprisen, and we can give you some additional insight into that.
Someone asks, I have a couple of credit cards. I pay the balances off every month, and student loans. Never miss a payment, no mortgage because I rent, no other loans, but my credit score doesn't seem to budge. How else can I improve my credit?
It's another good question. You really don't want to go into debt in order to boost your credit score, but there are certain mechanisms that credit scoring people look at. We talked about good debts, and the reason why I mentioned good debt is because the credit scoring companies look at mortgage loans and automobile loans as good types of debt because they build assets. You got something to show for your money. So in order to build that positive credit score, you may want to obtain maybe an additional card, use it, and continue to pay it off like you have been. I don't know how stuck your credit score can be because it sounds like you're really managing the process very well. But just to give you some insight into how the credit scoring people view things and what we've been told, that may be one way that you can build a positive, a higher credit score. Is to get an asset loan. And if you feel like you could handle home ownership, this would be a great time to buy a home.
Okay, so just for everyone, just really quick, Victor, if you've got a few more minutes, we'll go through a few more of the questions.
Sure.
Additionally, for those who have to hop off, we'll do as many as we can, and we will include them in the recording when we post it to the website. So that way, if you've got to jump off for other meetings or other obligations, please feel free, but know that they will be posted later so you can check them out. So here's the next one. Someone asks, what percentage of net income should go to savings?
Experts say you should be saving 10% of your income. And that's a standard. Now, when I made the transition from my my lending job to the nonprofit world, there was a decrease in income, but I still saved something. I saved 5% of my income during that period of time, and eventually was able to build that back up. But the standard that experts say you should be saving is 10% of your income.
Student loans will keep me out of that 15 to 20% total debt for a long while. Considering that, what should I prioritize?
Well, without knowing what else you might have, and you said you just had student loan debt, if that's the only thing that you're paying, then obviously you want to get that student loan debt paid off as soon as possible. As we talked about, creating a priority spending plan to really address that debt and get it paid off as soon as possible would be the focus. If you have any other types of debt, you have to make sure those get paid as well. And once again, I would concentrate on the high interest debt if you have any of that. But if your sole purpose is to get that student loan debt paid down as soon as possible, then create a strategy to do that and make more than the minimum payments. Usually student loan debt's got very low interest rates and good terms, especially if they're federal student loans. You should be able to reduce that debt in a shorter period of time if you create a strategy to do so.
Do you recommend doing power payments versus paying large loans off in full if one is financially able to do so? I've considered paying off a car loan in full, but heard the latter can negatively affect one's credit score.
Yeah, I think that if you have a really good interest rate or good terms on your automobile loan, you're probably better served to make the monthly payment on that, and because it does enhance your credit score, just making the monthly payment. Because what lenders are looking for is how you pay debts over a period of time, and that's where they get some of the parameters of how that score is going to go. As long as you're making those payments right on time and the debt's reducing over a period of time, they see that you have the discipline to make those payments on time and get that debt reduced. So you may be better served if that interest rate on that car is really low and really good to make those monthly payments on the car and not pay it off as soon as you would, say, if you have a 6-year or a 5-year loan, you pay it off in 2 years, you may be better off carrying it out to 3 to 4 years just so you can boost that credit score, because that is an asset loan, as we mentioned before, and it shows how you pay things over a longer period of time.
Just for everyone, we've got time for a couple more. Someone asks, I want to remodel my bathroom. Should I use an equity loan as I do not have a lot of money in savings?
Once again, I would say check your credit score first before you do something like that, because knowledge is power. And if you know what your credit score is going into a loan officer's office, or virtually, if you're talking with them virtually or whatever the case may be, then you can pretty much know what type of interest rate you can expect for borrowing that money. So I would say if you have a higher credit score, I would look into maybe taking a look at a home equity loan, depending on what the terms are. Once again, we talked about that. Those are important to consider and to get that job done. And as long as the interest rate's low and the terms are beneficial to you, that might be the better route for you to take.
Does saving 10% of your income include Roth IRA contributions?
It can. Usually that 10% figure is to be saved for emergency savings. And I'm going to add to that too. Experts say you should have at least 3 to 6 months worth of living expenses saved up for emergency. For example, when we talk about living expenses, we're talking about food, We're talking about what it takes to keep a roof over your head. We're talking about the utilities, all those things it takes to live, okay? Car payment, whatever the case may be. We're not talking about debt payments, credit card payments, medical bills, student loan payments, just things that you need to live. So if you figure out what it's going to take for you to just cover living expenses, work towards that as a financial goal. So that 10% could include both, your Roth IRA contributions and working towards the emergency savings that you need to have in place.
Okay, we will do one more, and then Victor, if you've got your contact info in the slides or anything, maybe just throw it up on the screen there, so that way people, if they want to get in touch, or if you've got any recommendations there, if it's visiting a website or what might be the best way for them to get involved. But
yeah, I think the best way for them to contact is through the EAP, because we have counselors available for immediate counseling and chat.
Great.
They can answer those questions as well.
Sure. Final question. When calculating debt to monthly income ratio for mortgage and personal debt, do you use take-home pay or net earned per month?
It would be your net income. So what you would do, and I keep it simple because I think monthly is the best way to take a look at it. So I would take a look at what your net monthly income is, and then what your payments are, your debt payments are. And if you want to include the mortgage, you can. Remember, we didn't include the mortgage in that debt to income ratio. It was just debt, because we figure that you got probably 30% of your income servicing either a mortgage or rent payments. Once you start getting over that 30% for housing, then you start getting into trouble as well with being able to maintain your living expenses also. So I look at it on a monthly basis. So take a look at your net monthly income and then what you pay out per month in debts.